Let me start with something controversial. Everyone keeps saying buy a rental property, collect checks, live the passive income dream, or the other camp, just put everything in the S&P 500, forget about it for 30 years. Warren Buffett said so himself. And you know what? Both of those pieces of advice are incomplete because neither one counts everything. Today I want to walk through the real numbers with you. No hype, no agenda, just an honest conversation like two friends talking over coffee. I built this channel for exactly these kinds of conversations. When you want real numbers, not motivational posters. If that sounds like what you're looking for, hit subscribe right now. It takes 2 seconds and you won't miss what's coming next. Let's get into it. Let's start with real estate. And let's start by killing the biggest myth right away. Everyone calls rental property passive income. But here's the truth. Rental property is a business, a small one, but a business. And like any business, it demands your time, your attention, and your nerves. Let's break it down with actual numbers. Say you bought a one-bedroom unit for $100,000. You're renting it out for $800 a month. You do the math, $9,600 a year, nearly 10% annually. Sounds amazing. But hold on, let's count everything, not just Therent coming in. First, CapEx, capital expenditures. Every year, you should be setting aside roughly 1% of the property's value into a reserve fund for replacing the water heater, the roof, the windows, the HVAC. These things will break, and they always break at the worst possible time. This isn't a maybe someday expense, it's a mandatory reserve. That's $1,000 a year gone before you've done anything. Second, vacancy. On average, a rental sits empty for about 1 month per year when tenants turn over. You're listing it, showing it, screening applicants, waiting. That's another $800 gone. Third, property taxes. The national average runs around 1.07% of assessed value per year. On a $100,000 property, that's roughly $1,070. And you pay it whether the unit is occupied or not. Fourth, landlord insurance. This isn't your standard homeowner's policy. Rental property insurance covers liability and loss of rental income, and it costs more. Budget $600 to $900 a year. And fifth, the one nobody talks about, your time. Managing a rental takes a minimum of 5 to 10 hours a month. Late night calls from tenants, coordinating repairs, handling disputes, bookkeeping, chasing down rent. At a modest rate of $30 an hour, that's $1,800 to $3,600 a year. And that's not free because those hours could have gone toward your career, your side business, your family, or just your sanity. So let's add it up. Total expenses, $5,400 to $7,400 a year. Out of your gross income of $9,600, you're left with $2,200 to $4,200. Subtract the value of your time and your real profit is somewhere between $400 and $600 a year. That's 0.4% to 0.6% on your invested capital. Is that what you signed up for when you became a landlord? Here's the kicker. If your time is worth $50 an hour instead of $30, your return on real estate after accounting for your time goes negative. Literally negative. You're paying to own this asset. That doesn't mean real estate is bad. It means you have to count everything, not just the rent check. Most people don't do this math, and that's exactly why they think they're making money when they're actually just slowly spending their time. By the way, if you've been through this yourself, drop your numbers in the comments. What do you actually net after all expenses? Real numbers from real landlords beat any theory. Now, let's talk about index funds. And yes, there are things they don't tell you here either. You put $100,000 into an S&P 500 index fund and you forget about it. Historical average return around 10% per year. After 10 years, thanks to compounding, you'd have roughly $259,000. After 20 years, $672,000. Sounds incredible. And there are still things worth understanding before you assume it's that simple. First, the lost decade. Look at the S&P 500 from 2000 to 2010. You start at the peak of the dot-com bubble and end at the bottom of the 2008 financial crisis. Total return over 10 years, negative 10% in nominal terms, before inflation. That actually happened. And if that was your decade, if you were planning to retire in 2010, it would have been a disaster. History doesn't repeat exactly, but it rhymes, and that's worth keeping in mind. Second, inflation. A 0% annual return sounds great, but if inflation is running at 4%, your real return is 6%. If inflation hits 8%, your real return drops to 2%. And in certain periods, inflation had eaten the entire nominal gain. What matters is purchasing power, not the number on your screen. Third, and this is the most important one, you. When the market drops 40%, like it did in 2008 and again briefly in 2020, most people panic and sell. They exit at the bottom, exactly when they should be holding or buying more. The Dalbar study shows the average investor earn suddenly 4% to 5% annually in a market that returns 10%, simply because they buy at the peak of euphoria and sell at the bottom of fear. An index fund is not autopilot F or everyone. It's autopilot only for people who can keep their hands off the wheel in turbulence. And that, believe me, is a skill you have to deliberately build. You need to understand market history. Keep an emergency fund so you're never forced to sell at the wrong time, and train yourself not to react emotionally to red screens. If this video is giving you something useful, hit the like button. It genuinely helps the channel reach more people, and it tells me this kind of content is worth making. One tap, that's all. Now let's talk about what happens when things go wrong, because that's where everything gets tested. I want to walk through two real scenarios. Both have already happened in history. Both could happen again. Scenario 1, stocks go nowhere for a decade. The market stagnates or slowly declines. This is basically what happened from 2000 to 2010. During that time, your rental property keeps generating monthly income. The value may not be growing, but you're collecting rent. Cash keeps flowing. In this scenario, the physical asset holds its own when paper assets are struggling. Scenario 2, home prices are flat, and inflation accelerates to 7 or 8% a year. Rents can't keep up. Tenants can't afford the increases, and your local market won't support them. Your operating costs rise with inflation, but your income doesn't. Real returns on the property go negative. Meanwhile, shares in companies that raise their own prices alongside inflation, energy, consumer staples, commodities, are protecting your purchasing power much better. The lesson from both scenarios is the same. There is no universal winner for all market conditions. There is only smart allocation across different assets, and an understanding of which economic environment you're actually in. The person who holds both tends to sleep better regardless of what's happening out there. Drop a comment below. Do you trust real estate more, index funds more, or do you split it? I'm genuinely curious what this audience thinks. Now, let's talk about taxes. I know it sounds boring, but this is where several percentage points of extra return are hiding, and most people are just giving that money away. In real estate, there's a tool called the 1031 exchange. If you sell an investment property and reinvest the proceeds into another property within 180 days, your capital gains tax is deferred, and you can do this over and over again for your entire life. You can keep upgrading properties, never paying tax on the growth, and ultimately pass assets to your heirs with a stepped-up cost basis, meaning they inherit with dramatically reduced tax exposure. This is one of the most powerful wealth-building mechanisms in the US tax code, and most people have never even heard of it. Then there's depreciation. The IRS lets you deduct the theoretical wear and tear on the building from your taxable rental income. Even if your property has gone up in value, you're reporting less income on paper. This is called phantom loss. No actual loss, just a lower tax bill. Experienced real estate investors use this constantly, and it can completely change the after-tax math. For stocks, the tools are different, but just as powerful. A traditional IRA or 401k, you contribute pre-tax dollars and you only pay taxes when you withdraw in retirement, when your tax rate is typically much lower than during your peak earning years. A Roth IRA, you contribute after-tax dollars, but all future growth is tax-free forever, completely tax-free no matter how large the account grows. Over 30 years, the difference between a regular brokerage account and a properly structured retirement account can be hundreds of thousands of dollars, just from choosing the right account type with no extra effort required. If you're not thinking about taxes when you invest, you're leaving money on the table. That's a voluntary gift to the IRS that nobody is asking you to make. If this is giving you ideas you haven't heard before, subscribe to the channel. This is exactly what I cover here. Not vague advice, but specific tools with real numbers behind them. Now the last piece of keys, and honestly, this matters more than all the numbers combined. Real estate gives you the illusion of control. You can see the asset, touch it, paint it, rent it out. It feels like you're in charge. But what you're actually managing is a set of risks you created for yourself. The tenant who stops paying and won't leave, the pipe that bursts on a Friday night before a long weekend, the rental market that softened after a new apartment complex opened 2 blocks away. Control is an illusion. You've just traded one type of uncertainty for another that feels more tangible. Index funds give you the illusion of simplicity. It seems like doing nothing is the strategy. Buy it, forget it, get rich. But doing nothing only works if you can sit still when your account is down 40% and everyone around you is saying the market is finished. You can't know whether you have that discipline until you're in a real crisis. You're not reading about one, not watching a documentary about 2008, but watching your actual money actually shrink in real time. Not before. That's why the best investment plan isn't the one with the highest return on paper. It's the one you can actually stick to through good years and bad ones without breaking psychologically. Because the smartest plan that you abandon at the first panic is worse than a mediocre plan you follow consistently for 30 years. And one more thing before we wrap, leverage. Because people love it in real estate and fear it in stocks, and both reactions are a little overdone. In real estate, a mortgage is normal and can work in your favor when used correctly. You put down 20% of your own money and control 100% of the asset. If the property appreciates 5% in a year, you're not earning 5% on your money. You're earning 25% because the gain is calculated on the full value of the property. That's the leverage effect, and it's exactly what makes real estate so attractive to people who understand the mechanics. But leverage works both ways. If the market drops, your losses are multiplied just the same. And a mortgage doesn't care about your vacancy rate. The bank wants its payment every single month, no exceptions. In stocks, leverage is far more dangerous. Margin accounts can wipe you out in a single bad week. That's why for most people, index funds without leverage is the right call. Modest, but you'll actually sleep at night. Before you make any decision, answer these honestly. What is your time actually worth per hour? If it's more than $40 or $50, self-managing rental property will likely eat your entire return once you account for your hours. Can you watch your account drop 40% and not sell? If the honest answer is no, work on that before putting serious money into equities. Do you have not just a down payment on real estate, but also a 6-month emergency fund? Buying property without a cash cushion is speculation, not investing. And are you actually using your tax-advantaged accounts, IRA, 401k, depreciation 1031? If not, start there. It's the lowest hanging fruit in personal finance. Like, count everything, not just the upside. Count your time, your taxes, your risk exposure, and your own psychology. That's when the numbers start telling you the truth. If you found this useful, make sure you watch my next video. I go even deeper into how to actually build a portfolio from scratch, how to allocate across different asset classes, and the most common mistakes new investors make that quietly cost them years of growth. The link will be right on your screen at the end. Don't go anywhere.